What if I told you that one simple habit could protect your profits, reduce your risk, and dramatically improve your long-term returns, all without picking new stocks or trying to time the market? It sounds too good to be true, right? Well, it's not. Most investors ignore this habit, and that mistake quietly destroys their gains over time. The habit I'm talking about is portfolio rebalancing. In this video, I'm going to show you exactly how to rebalance your stock portfolio effectively, when to do it, and how to avoid the common mistakes that cost investors a ton of money. If you want a portfolio that stays aligned with your goals no matter what the market does, then this video is absolutely essential. Let's get started. So, let's start with the basics. Why does portfolio rebalancing even matter? Over time, some of your investments will naturally grow faster than others. This means your portfolio slowly drifts away from your original plan. For example, your stocks might grow much faster than your bonds, which secretly increases your risk level without you even noticing. You might have started with a 60-40th stock-to-bond split, but after a bull run, you could be looking at an 80-20th split, making your portfolio far more volatile. Rebalancing is simply the process of bringing your portfolio back to its target allocation. It's like a regular tune-up for your investments, making sure your risk, your returns, and your overall strategy stay on track. Without rebalancing, you could end up taking on way more risk than you intended, miss out on long-term gains because you're over-concentrated, and even panic during market downturns because your portfolio isn't as stable as you thought. But with rebalancing, you get to lock in profits from your high flyers, control your risk, and stay disciplined instead of emotional. It's the ultimate sell high, buy low strategy, automated. Okay, so when should you actually rebalance? There are two smart approaches that most investors use. The first is time-based rebalancing. This means you rebalance on a fixed schedule, say every 6 months or once a year. This method is simple, predictable, and perfect for long-term, set-it-and-forget-it investors. You just mark your calendar, and when the day comes, you rebalance. The second approach is threshold-based rebalancing. Here, you only rebalance when an asset class drifts by a certain percentage from your target. For example, you might decide to rebalance whenever your stock allocation moves 5% or 10% away from your goal. If your target for stocks is 60%, you would rebalance if they grow to 65% or fall to 55%. This method is more precise and reacts directly to market movements. A pro tip: many savvy investors actually combine both methods for the best results. For example, they might check their portfolio every 6 months, but only rebalance if an asset has drifted by more than 5%. Now for the practical part, a step-by-step guide on how to rebalance effectively. Step 1 is to review your target allocation. Ask yourself, how much should be in stocks, bonds, ETFs, or cash? Has my risk tolerance or financial situation changed since I first set these targets? Your goals are the foundation, so make sure they're still solid. Step 2. Check your current allocation. Log into your brokerage account and see what percentage each asset now represents in your portfolio. It's a simple checkup to see where you stand today. Step 3. Trim what's overweight. This is where you sell a portion of the assets that have grown too large and are now above your target percentage. This is how you systematically lock in your gains. It might feel weird to sell your winners, but this is the key to managing risk. Step 4 is to add to what's underweight. Use the cash from selling your winners to buy more of the assets that are below your target. This means you're often buying when prices are lower, which is the heart of smart investing. And finally, step 5, always consider taxes and fees. When you sell investments in a regular brokerage account, you might trigger capital gains taxes. Try to do your rebalancing inside tax-advantaged accounts like a 401k or IRA first, since you won't pay taxes on those trades. Also, be mindful of any trading fees to avoid eating into your returns. To help you succeed, let's cover the common rebalancing mistakes to avoid. First, don't rebalance too often. Doing it every week or every month is usually overkill and can rack up unnecessary fees and taxes. Second, don't let emotions drive your decisions. The whole point of rebalancing is to be systematic, not to react to scary headlines or market hype. Third, don't ignore tax implications. A big tax bill can undo the benefits of rebalancing, so be smart about where and when you sell. And finally, don't keep changing your strategy based on market noise. Stick to your long-term plan. Rebalancing is all about discipline. So what's the final takeaway? Portfolio rebalancing isn't a flashy or exciting topic, but it is one of the most powerful tools that successful, long-term investors use. It's the silent workhorse that keeps your financial plan on the rails. When you rebalance correctly, you reduce risk, improve the consistency of your returns, and build the confidence to stay invested for the long haul, which is how real wealth is built over time. This one simple habit can be the difference between just guessing with your money and investing with purpose. If you found this video helpful, do me a favor and hit that like button, and be sure to subscribe for more simple, effective investing strategies. And I've got a question for you. Drop a comment below and let me know how often you rebalance your portfolio. Is it once a year, based on a threshold, or maybe you're just starting out?